everyone, and welcome to our panel event for the NextGen investors. We're going to be talking about disrupting real estate and defining the future of investing. Okay, so I'm going to preface and say sorry if my voice cuts off. This weekend we were in San Antonio for March Madness and didn't get the outcome we wanted, but we're so proud of our Cougs for making a historic run. So my name's Caleb Andy, and I am the Senior Investment Analyst. I work here at RedSwan in the ION building. Today, we're here to discuss a pivotal point in real estate, one of the world's largest asset classes, valued at about $380 trillion when you look at it on a global scale. Technological advancements and innovations such as blockchain, DeFi, and AI are reshaping many industries, and specifically for commercial real estate, it's enabling and enhancing accessibility to institutional-grade investments and opportunities for people more than ever before. This transformation coincides with an incoming historical intergenerational wealth transfer where up to $80 trillion in the US alone is being transferred from baby boomers into the hands of millennials and Gen Zers over the next decade to 15 years. And as a Gen Zer myself, that's a very exciting thing to hear, and I'm sure everybody in the room would like to capitalize on that, right? So at RedSwan, we're at the forefront of this change with the goal of equipping the younger audience, the younger generation, with the tools, resources, and education necessary to partake in smart and strategic investments into commercial real estate. We have amassed a pipeline at our company of over $9 billion in global real estate, and we plan to target additional opportunities for tokenization and for investments to revolutionize liquidity and access to global investment outreach. With that in mind, I'm excited today to introduce our distinguished panelist guests who are leading the charge in redefining real estate investing through technology. So first, on your far right, we have Laura Pamatian. She's with Height Zero Real Estate. And as a blockchain and luxury real estate executive, Laura bridges real estate, digital assets, and blockchain innovation. She has over 20 years of experience. She's led groundbreaking tokenization initiatives. She's developed SEC-compliant frameworks, and she's also driven institutional adoption of tokenization. As the Vice President of Tokenization at Upside.gg, she's collaborated with industry giants at Republic, Avalanche, and Solana, and supported $2 billion in tokenized products. As a real estate chair for the Florida Blockchain Business Association, Laura is proud to shape the future of this evolving industry. Next to her, we have DiRaimondo. Mitch is the founder of SteelWave Digital and the CEO of eCobalt Investing LLC, and he's also with Tyke Digital Ventures. In August 2021, after completing his undergraduate degree from Elon University, Mitch joined SteelWave LLC, and he also founded Tyke Digital Ventures, a leading real estate tokenization organization with an acute focus on democratizing financial projects and commercial real estate projects in the US. As a native Californian, Mitchell is a lifetime resident of San Francisco and the greater Bay Area. Next, we have Ed Nawakity. He's the founder and CEO of RedSwan, and he's revolutionized commercial real estate investment through tokenization. With over 23 years of real estate experience, Ed previously served as the executive director at Cushman & Wakefield. It's managed positions in over $2.7 billion in transactions. Ed is also at the forefront of digital securities, has his license with SEC and FINRA regulatory compliance. He's received his MBA from St. Mary's College in California, and his bachelor's from the University of Michigan. And also Ed, I got the opportunity to meet Ed because he was a Bauer Real Estate Program Advisory Board member at the University of Houston. Go Cougs. And lastly, we have Hunter. Hunter is a business development professional at RedSwan. He specializes in fund management, strategic partnerships, and international market expansion. He's also a graduate of the University of Houston, C.T. Bauer College of Business, and served as the president of the undergraduate real estate scholars at the University of Houston, and he's helped drive student change, engagement, and growth, and also part of many professional networking events here in the Houston area. So without further ado, I'll pass it along to Hunter, and we can get started with the panel.
Thanks, Caleb. Yeah, so this is a great opportunity. Really grateful to have everyone here. If you can't notice, I also do have a bit of a raspy voice. I was at Final Four, got back here pretty late last night, so we're a quick turnaround, and it's nice to have a really dynamic panel here. It's great to see a lot of familiar faces, a lot of young people ready to inherit this new opportunity. So with that being said, there's a lot going on right now. Caleb mentioned there's $380 trillion of real estate around the globe. And we think at RedSwan, we put out a disruption report, at least 5 trillion of that is going to be a market capitalization by 2030. So that's a lot of real estate. And so with this NextGen inheritance of wealth, $80 trillion being inherited in the next few years, there's a lot at stake, and so I want to bring this up because everyone on this panel has gotten into this position for their own reasons. So can you tell us some more about yourselves and what led you to getting into this? And we can start with Laura, if you like.
Can you hear me? Okay. Thank you. First, Ed, thank you for having me, and RedSwan team, the utmost professionals. I really do appreciate. This is a beautiful venue. My name is Laura Pamatian. I've been in real estate and development for over 20 years. I started my career on the island of Maui, selling second, third, fourth homes, a lot of investment product. I niched into luxury pre-construction, hotel-branded resort real estate, so worked with brands like Ritz-Carlton, Mandarin Oriental, Auberge, Fairmont, Grand Hyatt. Very, very long story short, 12 projects later, I pivoted into the blockchain space in 2020. I started to learn a lot about how blockchain was going to affect the real estate industry. And once I started to see where it was going, and I started to listen to a lot of the, at the time, pioneering experts like Ed, coming forward and explaining how tokenization was going to change the industry, I was sold. So here I am.
Mitch?
Yeah, I got involved into crypto in 2014, so obviously a radically different time than it is now. I went to school. The school did not see eye to eye with me with seeing crypto as a scalable asset. So I kind of set out. We had the idea, we're like, look, if we can trade volatility, we can control the risk. And if we can control the risk, we can get institutions to come into crypto. So we launched a fund. It was very successful. We scaled that. And when we graduated, we're like, look, what does the space need? And the space needs scalable assets. Real estate's probably the biggest scalable asset you could fill that void with. So we set out, we're like, look, if we can bring institutional grade, private, cash flowing assets to a market that is starving for that, we could be a forward leader. I met Ed, in 2021, 2020. We started talking back then. Our deal size was pretty big. Our smallest deal is 100 million. Our biggest is 2.5 billion. So raising that from retail investors was not the easiest thing. So we kind of stepped back and we're like, look, if we can make a hybrid vehicle that gives opportunity to traditional LPs to tokenize their interest, it'll kind of force the hand of the space. We set out to do that. We raised a fund. We've been buying assets with that fund with the mindset to bring those assets to the market over the next 18 months as the space develops. So we're kind of on the front edge. Not a lot of people are doing it right now, so we're excited to be a part of it.
Thanks. Ed?
I'm just looking at Mitch and thinking back when we first met, and we were on a Zoom call because it was COVID back then, and your father was in the conference room table with you and your associate, and we were talking about tokenization, and his father was scratching his head thinking, why am I in this room? And Mitch is trying to convince him this is the next big thing. And now his father is preaching tokenization. Mitch has started a company and a hedge fund with $500 million for digital assets. So it just shows you how people change and times change. But I want to just say, first of all, thank you guys for coming. I think this is amazing to have a good turnout. This is really all about you guys. We realize that the future is in your hands. There's $84 trillion, as Hunter said, converting from the traditional baby boomers, which is my group, to the next gen. And we want to make sure that you have the education and the experience to get involved in commercial real estate because 30% of all holdings of investments are real estate. And so it's going to make or break your future if you understand it. So we think by tokenizing and breaking it down is going to make it much easier for you to get involved. But how I got into it is because I was in commercial real estate for about 20 years. 18 of those years was head director, executive director for Cushman & Wakefield. And so I was dealing with a lot of major buildings like this when buying and selling on behalf of my clients. And I looked around and I always realized that I'm only selling to like the top 25, 50 people in the country in terms of institutions. I was never selling to friends, family, or anyone that looked like you guys. And it just occurred to me that something's wrong with that picture. And then one of my former colleagues in the company that I founded in 1999 told me to go to a blockchain conference, and I thought he was crazy. I didn't know what blockchain was. I thought it was Bitcoin. But he begged me to go, so I did go. And he said, pay attention. So I tried to pay attention. But I didn't go to all the conferences and listen to people talk about Bitcoin. I went to the exhibit halls to kind of see how they were using the technology. And it just blew me away that the technology was really, a mutable way of fractionalizing anything into shares. And all I can think about was capital markets. Then I met my partner, business partner at that same event. And RedSwan emerged into a blockchain company because I realized this is definitely going to be the future. Everyone thought I was crazy. My company thought I was crazy for leaving, to seven-figure job and starting on my own with a blockchain company. My wife didn't know. She knew I wasn't crazy because she knows me. But challenge. But I think now people are realizing that this is a technology that's going to revolutionize and is revolutionizing the world of finance. And I'm really glad that you guys are here to understand how it works.
I appreciate that, Ed. And yeah, it's quite something to talk with Ed. He's on the UH advisory board. That's how I met him. And I graduated back in May. So when I had the opportunity to be offered an opportunity to join RedSwan, I took it because it was so unique. It was so different. Ed was so convincing. And honestly, it's such a crazy opportunity to be in an emerging industry like this. So going into our next topic, I want to talk about the state of capital markets and real estate, interest rate environments, the valuation reset, post-COVID, low occupancies, election, tariffs. Ed, can you go into some of these?
Yeah, sure. So, real estate capital markets is really all about buying and selling and stabilizing properties and developing properties around the country, around the world. And I think over the past 4 years, let me go back. On the past 15 years, it was really easy being a broker because with interest rates falling, prices keep going up. So we look like heroes every time we break the record on new prices. But it's not really because we're the best salespeople. It's because when cap rates go down, prices go up just because, cost of capital is cheaper. But in the past 3 years, we saw the reverse happening. Interest rates are going up and cap rates are going up and prices are starting to fall. And as you can see now, and we're in 2025, the market is kind of locked. Not many banks are willing to lend because they're sitting on a portfolio of assets that have deflated in value and they really have no reserve left. And then you see developers who are developing properties who haven't been able to get out and get liquidity for the property. So it's kind of stopped that cycle. They need cash in order to be able to buy new properties from banks as well as their equity. So liquidity is the name of the game, and liquidity is kind of frozen in this current period of time. And I think this is where you're starting to see people look at other opportunities to generate capital. And one thing about tokenization, it provides this liquidity because it allows us to break down $20 million into $1 denomination, so we can make 20 million shares and pretty much IPO a property, just like you IPO a company. So we can take any dollar amount, because under Reg D, which is a regulation that the SEC has, you can raise as much money as you want under this regulation, and you can devise it so that your denominator is either $1, or it could be $100, or it could be $1,000, but it allows people to come in at a certain entry point that's more affordable. So, in the United States, it may be $10,000, and overseas, it might be $1,000 or $500, but it allows the markets to come in and bring new capital for these investors and these developers. And so I feel that this is a way, to start the flywheel spinning again by providing liquidity.
Makes a lot of sense. And Laura, can you talk about some inefficiencies that traditional real estate has faced, like the transparency and inclusivity?
Yeah, I think, exactly what Ed just said in terms of the real estate investment. In traditional markets, typically an investor will come in, they'll bring capital to a sponsor's deal that's going to deploy that capital to acquire a project or build another project, and their capital is locked up for years of time. So it's not just a couple of years, it could be 5, 8, 10 years of time that they won't see returns from that investment or being able to exit that investment. So I think that is probably one of the biggest challenges that tokenization is able to overcome in a real estate investment. In addition, as what Ed was saying, in terms of the level of investments, a lot of investors for traditional real estate assets are limited to a certain profile of investor, a very high profile type of investor, an accredited investor, due to the SEC regulation that the sponsor is offering that investment under. So basically what that means is that if I want to offer an investment opportunity to someone in a real estate project, I will go to the SEC and say, I'm going to offer this under these particular parameters. A lot of times that is what Ed referred to as a Reg D, and that limits the opportunity for the investor, specifically based around the rules of that particular regulation. So I think that what is starting to broaden, right, as we're starting to talk about the opportunity to democratize real estate and the opportunity to bring in new investors and broaden the investor pool, is really looking at the regulations and the exemptions that the securities are being able to be offered under, and being able to broaden that investor pool to investors that only want to allocate $100 investment or $1,000 investment, or allocate a certain percentage of their income. So it's really based around regulation.
And,
right. I think, touching on what Ed said, where is the market? Well, that depends on where you sit on the cap stack right now, right? I think what we're seeing specifically in the real estate market, West Coast, office is like holding, radiated material right now, right? You say office in a boardroom, eyes glaze over, conversation over. So what that's done is it's taken a lot of the traditional capital players and they've put them on the sidelines, which means it's opened up opportunities that we haven't seen in generations, right? You're buying into stuff that, San Francisco, for example, let's use Westfield Mall, that whole infrastructure. I'm sure you look at the news, San Francisco, probably not a place you want to be wearing a Rolex right now, right? It's not the best. So the real estate around it suffers. So Westfield Mall, they built it in 2009. It's a $1.9 billion deal. That right now trades hands for probably $100 million for the whole thing. What that does is it opens up the door for developers like ourselves, but it also gives investment opportunity to people that previously would have been priced out immediately. We're seeing a lot of our traditional players that the lines are going cold. We're not getting calls back. So for us, kind of bringing in this new age of capital and to kind of open up this door to Web3, call it what you want. It's pretty unique. So it's a convergence of two things at the same time. So I think it's a perfect storm to allow both retail and, smaller scale institutions, family offices, sovereign wealth that previously didn't play. There's a lot of opportunity to be eaten up here.
Yeah, so going forward, I mean, in the next 5 years, how do you anticipate changes, regulatory, a lot of economic headwinds taking place? There's a lot of change going on. How does that feel for you, Ed?
Well, I think that the world is getting smaller, and more players internationally are making investments in other markets. We travel around the world a lot to pick up new business and talk to investors, mostly institutional investors, and a lot of them are eyeing United States properties. We've been to all over Asia, but talk about Japan and Korea, South Korea. They would, and even places like Nigeria and Ghana, they look at their capital, and for example, in Japan, they can borrow money at 1.5% today, way less than we can borrow money in the United States. And so they're looking at, the United States looks like it's a good time to buy as properties have gone down with high interest rates. We can borrow at 1.5%. We can invest in the United States at 6, 7, or 8%. And then they have, because they're already advanced in this tokenization theory, they already have been selling billions of dollars of tokens to their general public. They don't have rules that eliminate the general public from buying. Like we have the institutional investors, accredited investors only. They don't have that. So they basically are borrowing money for a low cost, investing it, getting a higher dollar value, and then selling that same token to the general public at maybe 4%, which the general public is extremely happy to get because they're getting zero in the bank. So in different markets, different countries, there's different reasons why people want to invest their funds outside of their country. They look at the United States as being a stable dollar, the strongest currency in the world, and so they want to hold on to the dollar as opposed to holding on to the naira in Nigeria that's seen over 2,000% deflation over the past 3 years. So lots of reasons why people will invest, and we think opening the market up, the U.S. asset market to international investors is drawing a lot of capital in so that guys like Mitch at SteelWave can get cheaper capital to build their buildings as opposed to having to borrow right here in the United States and pay a higher price. So I see a lot of reasons why the world is moving towards the tokenization. It's just because it levels the playing field.
Yeah, so I think it's important to take a step back and say, what really is tokenization, right? I think there's a lot of misconceptions with the word and just the Web3, blockchain, crypto industry. When people talk about NFTs and art and all these things that can be very volatile, let's just take a step back. Laura, can you kind of just break down what tokenization is?
Yeah, thanks for that question. I think that that's really where the conversation goes awry a lot of times, is that we're talking about tokenization, we're talking about real estate, and there's so many different types of tokenization in real estate that the conversations get confused, right? We have the ability to tokenize real estate, which basically means just representing the title of that real estate asset onto the blockchain, right? So that would be a token. That would be tokenizing real estate. Tokenizing that real estate title and transferring that title to someone else, selling that real estate to someone else is selling tokenized real estate, right? But there's also the tokenization of real estate securities, which is what we all work in. That's a very different conversation. Real estate securities have been around for a very, very long time. The regulatory infrastructure around real estate securities is very robust. There's very clear, defined lines around regulation for real estate securities. And what we're doing currently in the tokenization of those securities, which just basically means writing those securities to blockchain, recording the information and data around that real estate security and writing that to a blockchain, right? So it's easier to manage. It's easier to transact. Yeah, I mean, I think that that's really the basis, yeah.
I just want to add something because I want to make it as plain as possible. in terms of how we tokenize, because I get that question a lot. And I think the steps are really simple. Most real estate, investment real estate, like the building we're in right now, is not owned by one person. It's usually owned by some entity, some LLC or SPV, special purpose vehicle. And so you can now verify that going to the title company or title department in Houston and verify that this SPV owns this address. We know that the SPV owns real estate. Now that real estate actually has a vertical built on top of it that's actually generating income. So now that there's already an entity in place, we don't actually tokenize the dirt itself unless there was no structure. But since there's a structure on it and it's making money, we go to the SPV and look at how it's capitalized. Usually it has a GP, which is a general partner who manages the building. Then it has LP shares, which are shareholders who are invested into the company structure. We go to the board of directors and ask them to convert the LP shares into stock, digital stock shares rather than paper shares, and they say yes. So we've already done our evaluation. We've gone to Cushman & Wakefield or Deloitte to make sure that we know the value of that net equity. So if this is a $100 million building with a $50 million loan on it, then $50 million of this is net equity. That's what we can tokenize. That's what we can distribute. Of course, we can't distribute the debt, otherwise we'd be tokenizing debt. But let's just keep it simple. We're distributing just the net equity of this building. So we know it's $50 million. We can divide that by $1, and now we can distribute 50 million shares of stock and give the owner $50 million back in his pocket, right, for him and his other general partners. That's really what tokenization is all about. And then we basically don't sell to one person at $1 because it would take too long to sell the capital that's necessary for like $50 million. So we create allocations, and we might say the minimum allocation is $25,000. So anybody who wants to buy in, they're paying $25,000 price of the dollar to get their allocation. But the good news is they get the same pro rata benefits as the person who owns 90% of it. If you own 5%, if it makes $1 or $1 million, you get your 5% of that $1 million, and the other people get their 95% of the $1 million, so it's pro rata. So it does give you the opportunity to actually own shares of a building, but in more ways than one, it allows you to diversify and own many different buildings all over the world, as many shares as you can afford. And I think that's what the whole game is about, is knowing how to dollar cost average and buy multiple properties.
Yeah. So Mitch, can you tell us how is this any different than a REIT?
Well, I mean, the way we look at it is this is CMBS round 2, but like on steroids, right? You're basically taking, let's say I have a $100 million deal. In that deal, I'll probably have a joint venture. You know, let's say it's 95-5. They'll put in, 95% of the equity. For easy math, let's say they put in $50 million, right? Well, year 3 from now, they probably want, 20-30% liquidity so they can go redeploy. So we'll take that piece and slice it up into different debt tranches and then tokenize that into secondary market, right? It's a piece that, retail investors can eat up. It's backed, it's bulletproof, and 9 times out of 10, those deals are leased by Apple, Google, Facebook, go down the list, right? So that they're not going to flop on their lease payment. Like, that's their marketing tool to who they're hiring. So for us, we're looking at it as, look, call it a stable coin, call it what you want, but you're really backing a cash flowing asset to it. And then you're fractionalizing that. And that's the best way to look at it, in the simplest way, honestly. And I think regulators are starting to look at it like that as well. They're going, look, these are securities, so why don't we allow them to be fractionalized and brought to open market? And the person that cracks that will be the person that cracks the next generation of wealth, I think. Yeah,
no, I think it's perfect to segue into our real world application topic, especially from a developer perspective, Mitch. I think you have a lot of really unique projects. How does this differ, than just marketing the traditional route?
Yeah, I mean, for us, like, our simple math is we'll go buy a piece of land. We'll usually buy it in a tech center where we see a tech center growing to. We'll build it up. We'll build like a campus style. We'll go to a group. Let's just use, Anduril, for example. Palmer, this is your campus, we'll build it for you. We get it bulletproof, we let them stabilize into that asset, and then we'll go sell it to a REIT, right, as a whole package. Well, we step back and we're like, why are we selling our best assets into open market? And then, 5 years from now, when the cycle comes back around, we're rebuying our assets and then redoing them and bringing them in. Why wouldn't we just hold it on our balance sheet? And that's really what tokenization allows us to do. It allows us to take that cash flow and push it off to, retail investors while we're still managing the property and developing it out to what it could be.
Yeah, that's really the key to it. We've always told property owners that if you had your preference, you would never sell your property. You think about how hard it is to find a good property, how to like I own property, and how hard it is to get it, to stabilize it, where you have good tenants paying income, where it's paying down your mortgage, everything is working perfectly. To do that and then flip it out and sell it and take a profit and then go try to find another one, that is what people do. But I think my best clients over the past 20 years that have made the highest profit are the ones who've never sold their property. They just recapitalize the debt, and some people have no debt. They're just taking cash off their property, and their property just keeps increasing in value. To me, those are the smartest investors. And at the end of the day, when this tokenization becomes very prevalent, you won't be seeing whole properties selling back and forth like you used to. Companies that I used to work for that was selling whole properties are going to have a different business model, because less and less, the more properties are going on the blockchain, the less whole properties are going to be sold. And so I think that, like he's saying, when you have a good property that's doing very well, it's smart to keep that property and keep rising the price. And so that's pretty much the cut of it.
I'll push it to Laura. So one important piece of this is the retail aspect and the community involvement and things like that. Can you talk some more about that?
Yeah, thank you. I just to kind of add really quick to what Ed was saying, in that real estate trading is going to evolve. The way that we're seeing it, or the way that I see it personally, is going to evolve into the shares trading, right? Rather than properties trading in their entirety, people will be able to buy portions of that real estate through a securities transaction, rather than going out and having to acquire the entire property. Or the owners of the property will be able to transfer their shares to another owner without having to, basically get the entire investor capital stack to agree to that decision. They can just go ahead and trade it. As far as retail perspective is, I really enjoy the vision of retail investors being able to participate in large assets, right? Not just institutional investors being able to participate in large real estate investments. The way that that's happening is through regulation, and the regulatory infrastructure, like I said, is robust. It's very much in place, and there's a lot of opportunities for sponsors to be able to offer real estate opportunities and investments to retail investors, not just through accredited investors where they're having to seek out constantly the top 6 to 8% of the entire investor population, right? Trying to get capital from that same group of investors that have been classified as accredited, but go to the entire population across the entire world, right? Anyone over the age of 18, and say, would you like to participate in my real estate opportunity, in this real estate investment? So I think that with the existing regulation that we have in place today, it fits very well into the opportunity of tokenization, being able to offer retail investors investment opportunities in large real estate assets, as early as today.
Yeah, no. And for Mitch, I remember you talked about that sand analogy, filling up a jar. I think that really applies to this.
For us, I think the first time we met, it was that LA deal, La Tijera, right? It was a $62 million deal, and for us, it was small. I'm like, look, let's go tokenize it. And we realized, we're like, wow, this is a lot harder than it looks. Because if you think, you're filling a jar with sand, and usually you want a couple, rocks in there before you put in a bunch of, small kernels. And those rocks are your institutional investors. Like, you just need them. Like, if you're trying to fill that whole jar with tiny kernels of sand, like, it's impossible almost to be putting that small check size to fill that big of a capital need. Now, if you get 2 or 3 institutions to come in, say it's $60 million deal, 3 of them at $20 million a pop, then they turn around, they go, okay, let's bring $5 million a piece to retail investors. We own the asset. We don't have a time constraint, right? It's not a 30-day acquisition period, right? You own it. Now, all of a sudden, you can get that secondary liquidity. And I think that's where you need those rocks in the jar before you can start, really scaling this market up.
Ed, can you talk about the global environment? We talked about the Middle East. We talked about Asia Pacific, the $9 billion pipeline. There's a lot going on.
Yeah, but I want to just make a point that may be relevant here to this audience, because I know when I was at your age, the golden dream was to buy my first house. And, I saved up to see if I could buy my first house. My first house was actually a duplex. Luckily, it gave me the mindset to rent out half, the other one side, and live in the other side. And the one I rented out paid the mortgage. So that mindset got me into going into more and more commercial real estate. But you think about today, you're trying to buy a house, and the average house is $600,000-$700,000. That's a major commitment for you to jump into, not knowing what your income stream is going to look like over the next 10 years. So if you put the house aside and rent, but you're able to have discretionary income, and you started buying into income-producing properties like what Mitch is building, properties like what we have on our platform, and is generating income for you at the rate of 6 to 9%, you're making money off your income, and you're growing wealth as those properties go up in value, and they do go up in value, because it's quite frankly, you can't manufacture real estate. So the more the population grows, the more the property is going to grow. But you can imagine over 2, 3, 4 years, when you've invested your money in different pieces of real estate, you might wind up with $500,000 to $1 million or more worth of real estate paying you 8 to 9%. After that point, you can buy any house you want to buy. But it makes more sense to start generating income as opposed to putting all your effort into one house that you can lose over a period of time because it's not giving you any income. But in terms of the international market, we've seen success. Like I said, we had a Middle East investment that gave us a $3.5 billion assignment because in the Middle East, they don't believe in interest. Everything is basically Sharia compliant. And so they have trillions of dollars worth of real estate, and they've started realizing, why are we putting all of our money in this real estate that's trapped? These dollars are trapped in all these real estates. That's trillions of dollars trapped. So they called us and flew us out to Qatar and said, hey, we like what you're doing with tokenization. We want you to tokenize $3.5 billion worth of our properties. And these are apartment buildings, retail buildings, high rises, even farms that produce alfalfa for the livestock, a whole platform, a portfolio of properties, because they wanted to liquefy their income or their equity out of the asset, but still control the asset and just pay out dividends to the shareholders. So that's one use case for them, is to get capital back in their pockets so they can now turn around and put new money into new projects rather than continue to put their own money into projects going forward. So that's one example. Here in the United States, we had apartment buildings where owners wanted to get out of the apartment completely, and we're trying to get the highest price. We found by fractionalizing the shares and bringing 35 investors in, it's almost like you take a pizza and you wanted to sell a pizza and you go to Domino's and it costs you $6 or $10. But if I brought a pizza in here and I was going to sell a pizza to you guys and I priced it at $3 a slice and I had 10 slices, I'd probably sell the $3 slices out in a heartbeat, and I just made $20 on that $10 pizza. Well, the same thing applies for tokenization. If an owner is trying to sell their property and they divide it into multiple pieces, you guys will probably pay a slightly higher price to get into a high-quality asset that you never, ever in your lifetime would be able to get involved in. And this is the way we feel we're bringing back quality to not just a younger generation, but people who've been left out of capital markets over the past decades.
Mitch, I want to hear how tech stack is getting involved in this, right? We talked a lot about regulatory, we talked about frameworks, right? But how about the DLTs, right? The blockchains?
I mean, look, I think there's a lot of room to grow. I think what you've been doing, honestly, probably speaks to a lot of the tech side. I mean, we do a lot of work with Solana directly. I'd say their team's my favorite. I went through the accelerator at Berkeley, so I met a lot of these guys in the early stages. We kind of watched them grow, and when you go through multiple market cycles, you kind of see the good, the bad, and the ugly, and you see who rises to the top and who doesn't. And we were trading everyone in 2017 out of the Caymans, 70,000 trades a year, 5-minute hold times, spit bets. And I would always say, look, you can't pick your winners, you can't pick your losers. We're too early. Now I think you're starting to get into these stages where you can start to see who's developing the tech to bring a lot of these real world assets on chain. You can see who's talking about actually doing scalable institutional investment ideas versus meme coins and stuff like that, right? Which are great, right? There's money to be made, but you're not going to get some sovereign wealth dumping $500 million into a project like that. Like, they need to be underwritable, scalable, institutional grade assets. And look, the tech side, I think there's a lot of room to grow. I think as regulatory agencies, especially in the US, start to open their mind up a little bit more, I think it's going from regulation through enforcement to putting in some guardrails where innovation can come back to the US. I think that would be big. But again, I don't think your winner has come to the scene yet publicly. That's for sure. I think there's a lot of room to grow on where this tech stack goes. And I think AI is definitely going to be a part of that as well. I think you're going to start to see some innovation come onto the scene that we couldn't have innovated ourselves. So we're excited about it.
Laura, I'm
Yeah,
sure you have lots
no,
to
I
say
just
about
completely agree.
Yeah.
I feel like there's, just like you said, we're really still at the beginning, even though the space is, whatever it is now, 15 years old almost. It's still, there's still so much opportunity. We always compare it back to the internet, right? When the internet came into, which probably a lot of you weren't even around during that time, but nonetheless, Netscape was like first on the scene, and now Netscape is like nowhere to be found, right? When it comes to the internet, it's Google and Safari and things like that. But with blockchains, everything is still, we talk a lot about interoperability. When developers are building on a certain blockchain, there's still, in order to really scale and reach the masses, they really have to have interoperability to other markets, to other chains, to other, exchanges, et cetera. So interoperability is still, there's still so much that has not been solved in that regard. So.
Yeah, I think tech is an ongoing process. We've been at this for 7.5 years, and we're continuously working on tech to make it easier for people to transact, because in the early stages it was very difficult, very complicated. And so I think that's where the opportunity is for many of you who want to get involved, because we're always striving to make a process of transaction much easier. Like you said, AI is actually coming in. We're using AI to interview all of our new customers that are coming on board. An AI agent live will say hello and speak to you in real words, and it's not like a pop-up. It's actually an AI person running an interview. And we think that's going to get better and better and better. But the real key is that we're always looking for people who bring us better ideas to make that process smoother. And as this industry continues to grow into the trillions of dollars, that just leaves so much opportunity for people like you to come in and figure out, not even know how to develop. I don't know anything about developing. I'm not a coder, I'm not a writer, but I can talk to people who tell me what they do and say, hey, you know what? I can use that. And they just tell me what the price point is, and we can plug that in, or we can lease that. And so I think that's the opportunity for tech. We work with like Stellar and Hedera. They actually pay us to improve the tech, to make it easier for users that they have in their ecosystem, so that they can buy and they can sell, they can create stable coins. So like I said, the world's getting smaller, but the opportunities are getting much bigger.
Yeah, and I think that, just to make that point also, is that as we're developing product, there's this leapfrogging effect that's happening, right? There's products that are starting to be developed. Everyone last year was all about stable coins, and now, yielding stable coins. Yielding stable coins are now at the forefront, and those who are developing stable coins today are now having to recalculate and, reposition
What's
to
a
be able
stable
to
coin?
compete with stablecoins, which is basically the representation of let's just say a digital dollar, a dollar on chain.
Yeah.
Is that a good enough?
It's like a dollar represented on the blockchain, right? 1-to-1 ratio for the most part.
I mean, I think the point is that there's just so much opportunity. Like, we're just barely scratching the surface. People like Ed have been at this bleeding edge pioneering for years, and we're still at the very, very beginning of, all of the advancements that we're going to come upon.
And I think, look, like what's going on in the market right now, like, yeah, it's probably not preferable if you're opening up your accounts and seeing a lot of the tech is starting to get gutted. But it needs to happen, right? Like periods like this are when you see actual companies build, right? Innovate. Your fortunes aren't made in bull markets, they're made in bear markets. And it's where you're positioning yourself, how you're positioning yourself, who you're in conversations with, that when the floodgates do open again, that's when you're gonna start to see the upkick. And we're seeing it too. I mean, every day, especially in the real estate space, you see a lot of jersey changing going on right now. But I think it's times like this are when you build your team and you pick your players and you grow from there.
But what I think is exciting and just is that the older generation, the major corporations, they're not there yet. They're not really adopting the technology as fast as they should. Some people are, but many are not. And many just feel like they're comfortable and don't want to change because they have fewer years ahead that they have behind them, and so they're not going to change. But those who can help them change, they're very open to saying, hey, please show me. And that, like I said, is a really big window of opportunity. I just came back from Australia, and they're very interested in the technology because one guy, this is a mining town, they're very wealthy from having gold mines and iron ore mines. But he said, the hard thing about commercial real estate is that the time keeps changing. That every 5 years I got to refinance. I have to, change. I can't control the time. But with my mining business, I don't have a problem with time. The miners there, all I have to do is go in there and grab gold out and sell it. I wish my commercial real estate was the same way, where I didn't have to worry about selling this property off or recapitalizing. And that's where tokenization comes in to help them stabilize that timing period. So just trying to show you there's lots of opportunities in this business.
Yeah, and speaking on that opportunity, we're talking about a lot of equity, right? The equity side of things, but I think it's important to mention the debt side, DeFi, and how stable coins are coming into play into real estate investments. And so, Laura, I'll kick it to you on the DeFi.
I'll just kind of like put this in an example. I don't know how the easiest way to do this, but say you're invested in a real estate asset, and you don't necessarily want to sell your investment, right? But you do need liquidity. And with tokenization, what we're seeing now is there are lenders that are willing to lend on the tokens. So if I bring $100,000 or $10,000 to a real estate investment and I need some liquidity, I need maybe $5,000, $50,000, I'm able to put my tokens up as collateral, have the DeFi lender, right, lend on those tokens and gain some liquidity to be able to deploy that capital for something else. So it's becoming really interesting, and I personally think that that's the future of liquidity. I feel like there is going to be a market for trading assets. There will be people that do want to, investors want to trade out of their investments, but I do feel very strongly that collateralizing those tokens is going to be the easiest, quickest way to liquidity for investors who don't necessarily want to part from their investment. So from a DeFi perspective, the DeFi loan would be what's lending on those tokens.
Mitch, you
Yeah,
got a
like-
crypto hedge fund. Can we talk a little bit about that and how you may even incorporate that?
Yeah, I mean, look, there's a lot of ways to make money in the space. I do think we call it next generation leverage. Call it what you want. We've had multiple high net worth individuals come to us with different options, but the one that I think you're going to start to see a lot more of are your early adopters into Bitcoin, for example, right? Some guy, he put $1,000 in 2010. Now it's worth $600 million, right? He doesn't want to sell because his tax liability is massive. He'll go to a bank, get a loan against that Bitcoin, then come to a person like me and go, hey, I want to go buy real estate that's cash flowing, get a current return on it, pay off his loan payment, and then tokenize that real estate into the market, right? So you almost have like a 3-level debt offering there, right? You're getting your initial position, you're getting the real estate, so the bank's happy. They get the appreciation of the Bitcoin, and they get the appreciation of the real estate. And then once you tokenize, all of a sudden they're getting liquidity. So it's a win-win for everyone. And you're starting to see some pretty complicated debt vehicles coming into the space. On the real estate side of things, I do think the group or the groups that crack your current return, 8% stable into hard assets debt line, they're going to have access to debt like no one could imagine, because debt markets don't exist right now, right? Like, we're trying to find a $100 million construction loan, and that's just not going to happen right now, especially at numbers that we can wrap our head around. I mean, it's SOFR plus 500 bips. So, I mean, that's almost impossible to underwrite.
Ed, you have a solution for that.
Yeah, well, how many of you here own cryptocurrency? Just raise your hand. Okay, and how many of you that own cryptocurrency have done DeFi? Just a couple. Well, I think that people with Bitcoin and stronger cryptocurrencies, they use DeFi because okay, there's one up top. As Mitch was saying, that if your Bitcoin has gone up to 100,000, you bought it at 10,000, you've got a serious capital gain there, and you're trying to figure out, how basically you're not getting the income off of it, so you're just hoping it keeps going up and up and up, and one day you'll start selling it off. But when you DeFi off of Bitcoin or Ethereum or these major cryptocurrencies, you have to pay an interest rate on DeFi, and a lot of times it's between 8 to 15%, depending on which DeFi lender you're going to. And the reason why they're charging you so much is because the risk on financing that Bitcoin is high. 2 months ago it was at 100,000, today it's at 79. So if any loan to value, that's a significant change in loan to value. Just like in the regular banking world, you got to make up the LTV, put more money in to get the LTV back up. Well, if you took that Bitcoin was $100,000, and you had $100 million of Bitcoin, for example, and you borrowed $20 million of that off your Bitcoin, and you wrapped it and bought real estate, $20 million of real estate directly. So that does two things. It locks in your Bitcoin value at $100,000, and you use it to buy a $20 million asset. That real estate asset is not going to drop in value, even if the Bitcoin does. And because a bank is now being able to collateralize, both assets, the $20 million real estate and the $100 million Bitcoin, there's less risk for them of the volatility, and therefore they may give you a lower rate, right? And if they give you a lower rate, let's say that now the rate is 6% you're paying instead of 9%, and you're buying a property that's paying you 9% or 10% interest, that additional 3-4% that you're making, first of all, the 6% is paying off your note, so that's easy. But the additional 3 or 4%, you can go invest and buy more Bitcoin if that's what you want to do. So it just helps to continue to build wealth, and that's a real simple cycle of building wealth and also reducing risk. So these are things that we want to explain and teach to folks who are involved with us, because we think these are easy strategies in order to continue to build wealth.
Yeah. Oh, well, I think we talked a lot on the high level, and I think it's important to also take another step back and talk about opportunities. We have a lot of people who are young professionals in this crowd. What is some, for y'all, right, your first steps, or what kind of opportunities do you think makes the most sense for getting into this industry? And I can kick it to Mitch. I know you.
Me first?
Yeah.
Well, I came into the industry at a way different time. I mean, the head of the business school like gave me an F because he's like, "Oh, crypto's not an investable asset class," right? So when we came up, we were really laying the groundwork for this. Now, I think you're starting to see a lot of these accelerators, especially at schools. They're starting to hand over capital to students to trade and actually like trade off their endowment. And they're killing it. And I think it's some of the smartest brains coming into the space. The biggest thing I can teach you is work ethic, drive, and wherever you go, they'll teach you what you need to know. Just keep grinding, I'd say, is the biggest thing, because it's learning, it's constantly being open-eared, it's constantly being like, all right, where's the ball going, not where has it been? And it's just keeping your ear to where the opportunities are going. And don't go where everyone else is going. I'd say that's the biggest thing, right? If 10 people are turning right, I'd go left, just to, go against the crowd. I mean, we do it in real estate, right? Like in our office, in our markets, we're buying when no one else could even fathom buying right now. I think that's kind of a life thing, right? When institutions are running, it's a good time to run towards it.
Absolutely.
Yeah, Ed?
That's great advice, and I think just to follow up on that, I think that you want to be where you don't have a lot of competition. When I got into real estate, there wasn't a lot of competition. Maybe there's a couple million real estate brokers in the Houston market, but only maybe 10,000 commercial real estate. So I thought that was a good place to go. I got my CCIM, so I was like on the leaderboard of that. But as I started to grow in that business, more people saw the money involved in that business, started jumping in, and now we have 100,000 commercial real estate brokers feeding off the same stock of customers. And so no matter how much business you bring in, you're actually paying more out. You're actually competing more. Our fee started off at 100 basis points on everything we sold. And by the time I was leaving, there was like down to 25, 35 basis points. So you're working harder to get less. And so one thing I learned and thought about tokenization and blockchain was that, hey, first of all, it changes the game. Now all of a sudden you need a security broker dealer license and a digital commercial real estate license, a broker dealer license, which really is only less than 1% of the market understands that. Not even people who are stock traders understand digital stock trading at this point, but that's going to be taken off. So I figured having that behind us was probably one way to have a value add that no one can compete with, or very few people could. And even today, I think that's one reason why we're one of the industry leaders, is because we kind of put it together and started early. But like she said, there's plenty of room and plenty of runway to grow. We're still at the infancy stage. So if I'm going to look for my first job, I want a job where there's not a lot of competition, where I stand up and I'm, a thought leader on a certain topic or an expert on a certain topic. And I think that's kind of where we are today when you start looking at, technology and converting with real estate, or technology and, or AI and applying to real estate, or something else, AI applying to medical. That's where you find the value. That's where you can really start charging what you're really worth, is because no one else can come in and beat you down in price and compete with you. So something to think about.
Laura?
No, I would agree. I mean, everyone in this room is ahead of a lot of the population out there in terms of understanding what this is. Like, learn the language, understand, the technology. The opportunities are going to be there. Blockchain is going to integrate into every vertical that is out there in every industry, right? In particularly in real estate, which is what we're talking about today. A lot of application is just the very traditional real estate positions that exist, analysts, asset management. A lot of those opportunities, those bigger companies, larger companies are migrating towards the blockchain space. So just being able to identify what companies are leading and trying to align with those companies, I would say.
I'll give one word of advice: don't go public, go private. You're going to learn a lot more, see a lot more. A lot more innovations going in the private sector right now than out of the public. So
Yeah, no, and for me personally, I think it's just about taking chances. When I met Ed, I was not thinking about tech, crypto, blockchain, anything like that. That wasn't on my radar. It was more so get into real estate, get into development, maybe capital markets. Capital markets obviously made a lot of sense, right? The environment right now is pretty constrained, but he was pretty convincing, and honestly, you just got to take some chances in life, and I think this is the perfect example, right? This is an exciting time, and that's why we want to open up the floor to questions. So I'm sure some of y'all have been writing down some notes. If you have any questions, feel free to shoot them away. We'll pass the mic around, but this whole event is just about sounding the industry alarm, right? We want everybody to be aware that change is coming, and it's coming pretty quick. So yeah, just feel free to raise your hand. We'll have people passing the mic around. I think Eric's gonna push it around. So yeah.
Hi, my name is Knighton. I have two questions. So my first question is, unlike REITs, once you tokenize the asset, are there any sort of restrictions if you're a retail investor regarding selling or buying your positions? And then the second question I have is, I actually live in the Bay Area, so there are a lot of investors who have multiple multifamily properties as their real estate portfolio. How do you see the tokenization of those assets for investors that have just a bunch of multifamily properties, not necessarily commercial?
Go ahead. You go.
Me? I'd say, look, Bay Area multifamily, it comes down to innovation coming into the city, and then that innovation is going to leak out, right? And it depends on where that multifamily is. If that multifamily is like in the middle of Oakland, that recovery time is going to be radically different than if it's sitting on Coit Tower area. Having said that, I do think there's so much capital on the sidelines in the Bay Area right now that it just simply can't be Detroit. And we're seeing it on our real estate, right? We're launching deals. We launched this big deal down in South San Francisco. We bought the land, perfect timing, 2020, and got it full entitled for lab. And now we're starting to think this might be an AI campus, right? So you're starting to see this new level of tech come onto the scene. But innovation needs to come back first, and that starts from the top. I think the biggest difference in '08 and this cycle are people realize that politicians matter, and where you're buying that real estate, it matters who's your local heads of policy. You probably have seen a lot more of that than me.
Yeah, first of all, your first question about liquidity is a good question. When you're tokenizing an asset, there's a primary issuance, which is where the seller sets the price and we issue out at that price and you buy. And then when you want to sell, you don't go back to the seller for redemption. You actually take your shares to an exchange, like our exchange or Binance or any exchange that sells digital assets, and you put an asking price, and then the market determines the bid. So that's your risk factor. But the nice thing about it is when you're talking about a private REIT, you have one seller, one buyer. You go back to the REIT, and he says, your NAV today is this, and they give you your redemption based on that. When you're looking at blockchain, you're talking about a global set of buyers. One can be from India, one can be from Africa, one can be from the United States, and they may have different prices they're going to offer you based on different needs. So I think you're better off having multiple people bidding on your asset than one. But when you start talking about multifamily portfolio or assets, I'm not sure if you're saying multifamily as being single-family residential houses, or you're talking about sixplex of units. Which one is it? Combination. So I think bigger is always better. And so if you're taking one at a time and trying to tokenize and bringing investors one at a time, it's like he said, you're getting a lot of sand, and it's going to be hard to fill up that investment cycle. But if you pull all those assets together and make a portfolio, and now you're saying you're in the $10 billion or $20 billion or $100 billion with all those properties, and you take the combined cash flow from all those properties, now you're addressing markets that are high net worth, retail, institutional, and I think you can get investors much faster.
Scale's the biggest thing in this space. Like no one really cares over a $50 million deal. You'll start drawing attention,
I do. I care about $50 million.
Well, I'm saying, like, if you're an institution, right, if you're looking at the crypto space for us, we have a fine line of where we can tokenize, right? Because if it's below 100 million, it's not worth our market officer's time. But if it's above 100 million while it starts playing, then you run into a time constraint. Okay, how long does it take? So there's a lot of, but scale is your biggest player.
Any more questions? Feel free to raise your hand. And
So my question is, I assume that none of your companies have proprietary blockchains for the tokenization. If you do, please let me know. If you don't, how do you go about selecting which blockchain to put it on? Or how do you go about the process?
So I guess you're speaking to me. We have selected blockchains that we are tokenizing on. We selected Hedera and also Stellar. At the beginning, we started with Ethereum, but we realized Ethereum was just too expensive and it wouldn't meet the masses. We couldn't get international investors to buy a small amount because the gas fees were pretty large. But now with like Ethereum, or with Stellar or Hedera, these fees now to transact are pennies to transact instead of dollars or hundreds of dollars. So we think that's better universally for people who want to put in $100 and it only costs them 10 cents to make that trade, or they put in $1 million and it costs them $1 to make that trade. So that's the blockchain we use. And another reason why we selected Hedera and Stellar is because, like for Hedera, they have a governing council of major corporations around the world to make sure the infrastructure is managed very well. And their focus is not just crypto or NFTs. Their focus is RWA because they want their users to actually have assets that have good, solid value. So hope that answers the question.
Okay.
Hi, my name is Adriana Irby. I go to Texas Southern University, and I just had a question about basically the banks. How are they capitalized off of this opportunity? Is there something that we should look out for, that we should know as the consumers that are buying these blockchains? How would banks be able to capitalize off of this? And just something that we need to be aware of.
I don't think banks are capitalizing on the opportunity, but I think they're, for the longest time, a little bit nervous about blockchain and tokenization. I think they're now starting to get into the consumer side, creating stable coins because they realize that there's an economy out there who's buying things with digital currencies, with stable coins or Bitcoin. And I think banks now are creating their own stable coins backed by their deposits so that you can now take your crypto and buy your stablecoin crypto and buy different products. But in terms of bank loans, when it comes to commercial, some of them have restrictions on how much you can recapitalize. For example, if you're an owner of this building and you have 35% equity in this building and the bank has the balance 65% debt, they don't want you to sell off your 35% to a million investors and you don't have any skin in the game anymore. So they want to make sure that you sell up to maybe 90% of your equity so you stay in as a KP because they need somebody responsible for the asset. Good question.
Yeah, he's on his way.
Hey, y'all. My name's Chris. One of the main things y'all talk about is the need for liquidity within just the commercial real estate space. But I'm worried, or not worried, but curious about how the volatility within the crypto market affects, not even just the tokens, but the actual generating the liquidity needed because the crypto space is so volatile. Are you talking about these tokens as fixed rate assets that you're getting? I know, Ed, you mentioned, we're going based off the cash flow of the property itself, but I mean, just trading them throughout the retail consumers, is that going to lead to volatility within it outside of just the fixed rate?
Very good question. I think that the reason why you see volatility with crypto is because it's very emotional and it's not backed by anything. And sometimes it could be mass produced, so they can just keep adding more and more crypto to the balance to the chain. But when you talk about tokenized real estate, you're talking about assets. So you're not talking about just you're talking about a tangible asset, and that tangible asset is you can't reproduce it and just continue to add on more assets when you have a finite number. But I think it also stabilizes the volatility because real estate doesn't move very much. I mean, from month to month, if you buy a property that's stabilized in terms of occupancy, the cash flows are coming in on a regular basis, and it's not like it's going to drop in occupancy from 100% to 20% overnight or in 4 or 5 months. It usually stays pretty steady. If something happens, it happens to all properties in the area, and then it comes back. So I think it's just much more stable than a crypto that really doesn't have anything as behind it, so to speak.
Yeah, and to touch on Ed's point, I think when you can imagine, like you go on your Charles Schwab account, you buy a stock, you're bidding for a stock, and there's an ask price. So it's the same concept for the secondary market. The market's going to dictate the value, but there's financials that are being put out there that helps give you a more stable, more safe approach to understanding the value.
But where you can see trading take place is because even real estate, you have an asset that's paying you 10% yield on a quarterly basis. But a hurricane has hit Houston, for example, and some properties was coming, and people said, you know what, I'm going to sell out now because I think it might be a big hurricane, and I don't want that asset to go to zero or to lose a lot of value because they have to restructure. So they might sell out, and they might be more anxious to sell, and the average price may be $10. They may sell for $9, right, because they're a little worried about the hurricane. And you might think that I checked the most recent trajectory and is actually going to Louisiana, not Houston. And so you might buy that $9 knowing that it's actually not going to affect it. So I think there's going to be trading based on that kind of data, but not just because the real estate is going to lose value because it's a digital asset.
Hello, thank you for hosting this event. My name is Helen. I'm a student at the University of Houston, and my question is in regards to the concept of the capital stack and how the equity piece is tokenized. What does that look like in a construction, and how do you navigate the risks that are associated with maybe an ongoing construction, and if even that is like the case, if you guys even tokenize the construction piece?
Yeah, I think construction loans are. There's obviously more volatility there because you can imagine the asset, it's just dirt at the moment. But if that developer has a great reputation, like Steelwave, for example, most definitely that's a tokenizable piece of the capital stack, and there's going to be a promised return afterwards. So I think just coming up with the right accredited kind of developer, and Mitch, you can speak more on that. I think it's...
Yeah, I mean, usually with construction, you'll split it into phases, at least at scale. So we'll do like phase 1, 2, 3. And obviously it hasn't been done yet. What we've talked about is releasing different risk opportunities for each one of those tokens. So like obviously if you're day 1 construction loan, that's going to be a higher payment than if you're in phase 3. But at the same time, I think instead of trying to think of it, at least to start, because if you're trying to think of a ground-up development and you start tokenizing, there's so many things that can change at once, right? You could have a plethora. You could have an LP leave. You can have, entitlements not go through, whatever it might be. You almost have to think of it as you're tokenizing an N-piece deal, but you're fractionalizing each one of those LP slices, right? So if I have a $100 million deal, we'll probably have 2 or 3 LPs. Let's just use Walton Street sits in for $40 million, right? Well, Walton Street, they see that, they know the underwriting of the deal. Hey, we want to go deploy into your new fund offering. Let's tokenize 10 million. Let's wrap that into a level of risk that you can then put into. And that's why we call it like CMBS round 2, right? It's really taking these finalized deals and getting your liquidity. It's hard to get sourcing money to do the development right now. I think that'll change, but as it sits, I think it's mostly going to be...
Are you going to price different prices on those different levels?
I think so, and to answer kind of the mark-to-market question with like the hurricane and stuff, it all depends on the variables you put into your mark-to-market. Obviously, as a developer, I want that to be consistent, so I'm going to say, hey, let's keep less variables in there. Where in open market, retail investors they'll obviously want more. So I think it's finding that fine line where you're not going to get fluctuations off of weather or off of, what the market's doing that day in your market, right? You want at least a quarterly stability rate that you can underwrite, because that's when you can start putting in your waterfalls and seeing how it shakes out.
You also have market data to compare to as well, to know how the rest of the market is doing in comparison to the property you're thinking about investing in. So that gives you some brackets to operate from.
My name is Emmanuel. I'm in the energy business, so I don't know much about the blockchain and whatnot and all this technology, but I'm a numbers guy. So you mentioned earlier about 380 trillion, I think the total market value of all real estate in the world. My question is, what percentage of that currently is tokenized, and how much upside potential do you think that has in terms of like 50% you expect that to be tokenized or 30%? Like, you could just elaborate on that. That's all I got.
Yeah, there's under, I'd say, 50 billion of real estate tokenized right now around the world. We think that there's about $30 trillion kind of managed by the major institutions, the BlackRocks, the KKRs, the Starwoods of the world. But there's $320 trillion of real estate around the world. So I think that, as we mentioned in our prediction, this is not us speaking, it's Boston Consulting Group making the statement that by year 2030, there's going to be tokenized assets will be around $16 trillion, right? And if you look at real estate being a third of that, so that's roughly $4 trillion of real estate that's going to be tokenized, a little bit higher than 4. But that's how we're looking at it, and it's going to continue to scale because, if you had the option to buy two buildings, this building and one just like it right next door, right? And the one next door was the traditional way you put your money in, you buy the building, and you own it, you have no liquidity. If you want liquidity, you have to give a broker like me to go out and sell it in the market, versus the same building next to it, which is same occupancy, same profit, and it has liquidity, whereas you can turn around and sell it to shares internationally today, tomorrow, anytime you want. For the same price, which one would you choose? The one with options, right? So that's why we know that it's going to continue to be the preference for people once they get it, because it's like a no-brainer that you want to have the option to be able to raise capital whenever you want by selling partial shares of property, as opposed to only being able to sell the entire property off to get out. So that's hopefully kind of answering your question.
Yeah, and I was going to say, like, the beauty of this is on chain, right? So there's groups out there that basically have like a leaderboard of what is going on chain, right? Like rwa.xyz, they're posting who's on the leaderboard, and right now it's a lot of treasuries and money market funds, like BlackRock and Franklin Templeton have $1 billion funds out there, right? And real estate is still slowly lagging behind, but sooner or later, these are big ticket properties. You're going to see that number increase, and blockchain is basically like this immutable ledger that you'll be able to track all these types of transactions taking place. So I think it helps really put things into perspective going forward.
I know this guy had a question.
Determining what assets y'all are going to invest in, and I guess where do y'all see the office sector in like the next 10, 15 years? Like, would y'all be open to tokenizing any office, or are y'all kind of just...
I'll throw it on you.
I think, look, this is some of the best buying opportunity we've ever seen. I'm a big office proponent, but no one's going to go back to the office in traditional format, right? We're buying office space. We're going, look, we're going to blow out 60% of this office space. We're going to make balconies on the side, high-end food, high-end amenities, make it a mixed-use deal that people want to come back to. So then what do we evaluate? Well, location. Where do people want to go to, right? Tech centers like San Francisco, LA, Orange County, Seattle. probably not Portland. Yeah, Denver, Austin, Houston, Phoenix, areas like that, right? And then you start to evaluate it, like we're looking at Westfield Mall, it's office, well, what's replacement cost? You're almost buying it at land value at a certain point where it's like, okay, let's level it and make it what it could be. Because the lenders want out, right? The LPs need cash flow, right? And anything's better than zero. So I think that's where our buying opportunity is right now.
And see, he's opportunistic because he's a developer, so he's looking at ways he can buy great locations at land value and convert something, a reuse, that's going to have a higher and better use. Whereas as our platform, we're looking for opportunities that are going to be enticing for you to invest in. We want income-producing properties so that day one, you're going to get income from this asset. We also want assets that have been unavailable to you. For example, Class A properties like this building or like what you see in the CBD, brand new apartment buildings, brand new retail centers, properties that he builds, because these are opportunities that you would normally not have the reach or the capital to buy. So we think fractionalizing those will give you the opportunity to generate the same kind of yields that the institutions who invest in those properties are getting. So that's one. We're also, because of these young guys on our team, we're looking at beachfront boutique hotels because we think that this is a way that you can now have vacation properties that you own and visit once a year or twice a year at different beachfront hotels around the world to make things interesting. So this is what we go after. We think it's going to be kind of fun to be able to buy into those kind of assets.
Yeah, to Ed's point, it's pretty awesome that with RedSwan, we have a lot of different types of offerings for all types of people. We have institutional partners that seek nice, high-end multifamily that's stable in core markets, but then you have other groups out there that are seeking a bit more risk, higher yields, and that comes with our international offerings, right? The beachfront properties out in, some Caribbean islands. So it's cool because we can kind of choose our destiny, and I think a lot of it is where the market's heading. So yeah.
I just want to say that another reason why you guys are here is because you're kind of our test case. We think that your demographic is the demographic we want to service over the next 50 years. And so we're going to be onboarding a lot of NextGen to our platform, asking them questions, doing polls to find out what you want to invest in and make sure we can bring those assets to the platform so that you have an opportunity to buy the things that you've always dreamed of in terms of commercial real estate.
But yeah, we'll just wrap it up here. I want to thank you all for taking the time to come out here and hear our panel on real estate tokenization. It's great that there's a lot of interest in this industry, and it's only going to keep growing. So if y'all want to stick around, network, chat with us, feel free to ask more questions. But this is our time here, and thank you, Red, and the panel. Let's give them a round of applause.
you.